It's the turn of the decade, and as always, Wall Street is abuzz with speculation about what the future holds for investors. But no one has a clearer idea of how to navigate these uncertain markets than BlackRock, arguably one of the world's most influential asset managers. In this video, we will delve into their predictions for 2023 and uncover where they are investing their money in order to make profitable returns. Hello! Before starting our video, don't forget to smash the subscribe button and click the notification bell for more amazing content. Now let's get this video started. A new investment playbook. BlackRock, one of the world's largest asset management firms, has warned that 2023 will be a year of recession unlike any other in history. According to BlackRock's recently released 2023 Global Outlook report, a new economic playbook is necessary in a world defined by a supply-based economy and high levels of inflation. Its 2023 Global Outlook has been headlined "A New Investment Playbook," reflecting the new regime of high macro and market volatility. Previously, the firm would position itself with a single set of investment views for the next 12 months and apply them throughout the year. However, now that the easy context of macro stability, low output, low volatility, and inflation had ended, the company needed to chart a new course and accept a willingness to change. Given the market scenario for the next few years, the new move was not controversial, but it was necessary. Scars of the energy play will be visible in 2023. Instead of offering investment scenarios and then the playbook for them, BlackRock focused on incorporating the capacity to respond to changing market conditions. This entailed throwing away the old playbook and introducing a new one, notably challenging traditional financial truisms that were useful during the low interest rate, high QE era. Mantras like "buy the dip" were no longer applicable. You cannot simply buy the dip. You must first examine the macro damage and then assess what is in the price before doing anything. The investment firm also blasted the optimistic herd mentality that because things are bad, they must improve. Many individuals believe that because 2022 is so horrible for markets, it can only be better in 2023. While the investment house believes that some aspects of the situation will improve next year, its outlook is more complicated than just anticipating a regression to the mean. Making assumptions is a bad strategy. This contributes to the first of BlackRock's three important themes for the upcoming year: sizing the damage from this year and observing what is priced into markets. According to the report, equities prices do not properly reflect the turmoil that has occurred this year, and so do not accurately reflect market risks. For example, previously the S&P 500 was overly bullish following earnings season. Days before this outlook was published, U.S. equities rose on the back of Federal Reserve Board Chair Jerome Powell's comments that the Fed's rate hike policy could slow. But investors had only listened to part of the speech and ignored the chair saying that rates would remain higher for longer, not that the Fed was changing its policy. Delivering in 2023 will necessitate investors abandoning many of their innate biases, especially when many economies undergo what BlackRock refers to as a foretold recession. In 2023, private markets will face a reality check. The strategists also warned the approaching recession would be driven by the central banks over tightening, echoing the paper's analysis that central bankers will not ride to the rescue when GDP slows in this new regime, contrary to what markets have come to expect. The second theme included rethinking the importance of bonds in portfolios. There is this instinctive kind of tendency in a recession to want to hide in long-duration bonds, since that used to be the traditional recession playbook. However, according to them, we genuinely need to think hard about the cause of the recession and then where to hide, which for them is in income. As a result, BlackRock's portfolios are currently at their most defensive, although nominal long-term government bonds are underweight. Living with inflation is the third theme. As previously stated, BlackRock's base case expects inflation to be structurally higher over the next several years due to aging demographics, political fragmentation, and even the net zero transition, implying an overweight to inflation-protected bonds. By the time the strategists begin touring it more widely in the new year, the outlook could have shifted substantially. We are announcing the outlook in December, and this is what we believe today. But as we take this on the road in January, We may have made some other modifications to the present portfolio composition because who knows what could happen, the strategist said. The basis of this new approach was to be dynamic and get ready for changing views very, very quickly, the strategist added. So, what about crypto? The firm has also issued its opinion on crypto and cryptocurrency startups. Larry Fink, the chief executive officer of BlackRock, claimed that he anticipated the majority of cryptocurrency companies would not survive the demise of FTX, one of the market's leading cryptocurrency exchanges. However, he acknowledged that blockchain technology will be an important tool for tokenizing securities in the markets of the next generation. It's always interesting to see where the big money is flowing. And while we may not have millions to invest, it can give us a sense of which way the wind is blowing. Looking at BlackRock's predictions for 2023, we can get a sense of where they think the next big opportunities lie. Interesting potential investments include blockchain tech and equities. What do you think? Are any of these areas worth investigating further? Let us know in the comments. If you liked the video, please give it a thumbs up and subscribe to the channel. We're grateful for your time. We'll be back soon with more interesting videos.